Hello there. Let's talk about risk, insurance, and financial markets. First, we will go over the problem of imperfect information and asymmetric information. And then we will move on to insurance, and we will end with Chapter 17, Financial Markets. There are two possible problems with respect to information exchange between sellers and buyers. They are imperfect information and asymmetric information. Asymmetric information is a situation where one party has more information than the other regarding the quality of an item of interest. For example, when we buy a second-hand car, the seller or owner of the car might know more about the car's real issues and history than we do. Or when we buy health insurance, we might know more about our own health than the insurance company. Imperfect information, on the other hand, is a situation where either the buyer or the seller, or both, are uncertain about the qualities of what they are buying and selling. Using the same example of buying a second-hand car, since a car is a complicated machine, both the seller and the buyer might not know all the hidden problems with the old car. Or in the example of buying health insurance, both the buyer and seller might not know all the hidden health conditions of the buyer because there are many conditions that don't show any serious symptoms until too late, like high blood pressure, cancers, or diabetes. Similar problems with imperfect information arise in labor and financial capital markets as well. Consider a person who is applying for a job. Her potential employer, like the used car buyer, is concerned about ending up with a poor quality employee. The employer will collect information about her academic and work history. Employers may view awards, a high GPA, and other accolades as a signal of hard work, perseverance, and ability. Employers may also seek references for insights into key attributes such as energy level and work ethic. But how can a potential employer screen for certain attributes such as motivation, timeliness, and ability to get along with others? In the end, however, a degree of uncertainty will inevitably remain regarding the candidate's abilities, which are hard to demonstrate without actually observing her on the job. The presence of imperfect information can discourage both buyers and sellers from participating in the market. Buyers may become reluctant to participate because they cannot determine the product's quality. Sellers of higher quality or medium quality goods may be reluctant to participate because it is difficult to demonstrate the quality of their goods to buyers. And since buyers cannot determine which goods have higher quality, they are likely to be unwilling to pay a higher price for such goods. Economists sometimes refer to a market with few buyers and few sellers as a thin market. By contrast, they call a market with many buyers and sellers a thick market. When imperfect information is severe and buyers and sellers are discouraged from participating, markets may become extremely thin as a relatively small number of buyers and sellers attempt to communicate enough information that they can agree on a price. A buyer confronted with imperfect information will often believe that the price reveals something about the product's quality. For example, a buyer may assume that a gemstone or an used car that costs more must be of higher quality, even though the buyer is not an expert on gemstones or cars. If you are hiring a lawyer, you might assume that a lawyer who charges $400 per hour must be better than a lawyer who charges $150 per hour. In these cases, price can act as a signal of quality. When buyers use the market price to draw inferences about the product's quality, the markets may have trouble reaching an equilibrium price and quantity. Imagine a situation where a used car dealer has a lot full of used cars that do not seem to be selling, and so the dealer decides to cut the car prices to sell a greater quantity. In a market with imperfect information, many buyers may assume that the lower price implies lower quality cars. As a result, the lower price might not attract more customers. Conversely, a dealer who raises prices may find that consumers assume that the higher price means that cars are of higher quality. As a result of raising prices, the dealer might sell more cars. The idea that higher prices might cause a greater quantity demanded and that lower prices might cause a lower quantity demanded runs exactly counter to the basic model of demand and supply. These contrary effects, however, will reach natural limits. At some point, if the price is high enough, the quantity demanded will decline. Conversely, when the price declines far enough, buyers will increasingly find value even if the quality is lower. In addition, information eventually becomes more widely known. An overpriced restaurant that charges more than the quality of its food is worth to many buyers will not last forever. So what are some mechanisms to reduce the risk of imperfect information? Buyers and sellers in the goods market rely on reputation as well as guarantees, warranties, and service contracts to assure products' quality. The labor market uses occupational licenses and certifications to assure competency, while the financial capital market uses co-signers and collateral as insurance against unforeseen detrimental events. In the goods market, the seller might offer a money-back guarantee, which is an agreement that functions as a promise of quality. This strategy may be especially important for a company that sells goods through mail order catalogs or online, whose customers cannot see the actual products because it encourages people to buy something even if they are not certain they want to keep it. Sellers may offer a warranty, which is a promise to fix or replace the good, at least for a certain time period. The seller may also offer a buyer a chance to buy a service contract where the buyer pays an extra amount and the seller agrees to fix anything that goes wrong for a set time period. Service contracts are often an option for buyers of large purchases such as cars, appliances, and even houses. The rationale for this policy is that firms want repeat customers, who in turn will recommend the business to others. As such, establishing a good reputation is of paramount importance. When buyers know that a firm is concerned about its reputation, they are less likely to worry about receiving a poor quality product. For example, a well-established grocery store with good reputation can often charge a little higher price than a temporary stand at a local farmer's market where the buyer may never see the seller again. Job candidates or sellers of labor provide information through resumes, recommendations, school transcripts, and examples of their work. The labor market also uses occupational licenses to establish quality in the labor market. In the financial market, before a bank makes a loan, it requires a prospective borrower to fill out forms regarding income sources. In addition, the bank conducts a credit check on the individual's past borrowing. Another approach is to require a cosigner on a loan, that is, another person or firm who legally pledges to repay some or all of the money if the original borrower does not do so. Another approach is to require collateral, often property or equipment that the bank could have a right to seize and sell if borrower does not repay the loan. The mechanisms that we mentioned above can reduce the risk associated with imperfect information so that the buyer and seller are willing to proceed, but that might still not be enough. People would need some sort of insurance to prevent any single event from having a significant detrimental financial effect. Again, insurance is a method that households and firms use to prevent any single event from having a significant detrimental financial effect. Generally, households or firms with insurance make regular payments called premiums. The insurance company prices these premiums based on the probability of certain events occurring among a pool of people. Members of the group who then suffer a specified bad experience receive payments from this pool of money. Many people have several kinds of insurance. Health insurance that pays when they receive medical care, car insurance that pays if their car is in an automobile accident, house or renters insurance that pays for stolen possessions or items damaged by fire, by water, or bad weather, and life insurance which pays for the family if the insured individual dies. All insurance involves imperfect information in both an obvious way and in a deeper way. At an obvious level, we cannot predict future events with certainty. For example, we cannot know with certainty who will have a car accident, become ill, die, or have his home robbed in the next year. Imperfect information also applies to estimating the risk that something will happen to any individual. It is difficult for an insurance company to estimate the risk that, say, a particular 20 years old male driver from New York City will have an accident, because even within that group, some drivers will drive more safely than others. Thus, adverse events occur out of a combination of people's characteristics and choices that makes the risk higher or lower, and then the good or bad luck of what actually happens. So how does insurance work? A simplified example of automobile insurance might work this way. Suppose we divide a group of 100 drivers into 3 groups. In a given year, 60 of those people have only a few door dings or chipped paint which cost $100 each. Another 30 of the drivers have medium-sized accidents that cost an average of $1,000 in damages, and 10 of the drivers have large accidents that cost $15,000 in damages. For the moment, let's imagine that at the beginning of any year, there's no way of identifying the drivers who are low risk, medium risk, or high risk. The total damage incurred by car accidents in this group of 100 drivers will be $186,000. That is, you can see on the screen here, the total damage equals 60 drivers times $100 plus 30 drivers times $1,000 plus 10 times $15,000 in damages. They equal $186,000. If each of the 100 drivers pays a $1,860 premium each year, the insurance company will collect the $186,000 that is needed to cover the cost of the accidents that occur. Since insurance companies have such a large number of clients, they are able to negotiate with healthcare and other service providers for lower rates than the individual would be able to get, thus increasing the benefit to consumers of being insured and saving the insurance company itself money when it pays out claims. Insurance companies receive income from insurance premiums and investment income. The companies derive income from investing the funds that insurance companies received in the past, but did not pay out as insurance claims in prior years. The insurance company receives a rate of return from investing these funds or reserves. The companies typically invest in fairly safe, liquid, or easy to convert into cash investments, as the insurance companies need to be able to readily access these funds when a major disaster strikes. Not just private companies provide insurance. Federal and state governments run a number of insurance programs too. Some of the programs look much like private insurance in the sense that the members of a group make steady payments into a fund, and those in the group who suffer an adverse experience receive payments. Other programs protect against risk, but without an explicit fund setup. Following are some examples: unemployment insurance. Employers in every state pay a small amount for unemployment insurance, which goes into a fund to pay benefits to workers who lose their jobs and do not find new jobs for a period of time, usually up to 6 months. Pension insurance. Employers that offer pensions to their retired employees are required by law to pay a small fraction of what they are setting aside for pensions to the Pension Benefit Guaranty Corporation, which pays at least some pension benefits to workers if a company goes bankrupt and cannot pay the pensions it has promised. Deposit insurance. Banks are required by law to pay a small fraction of their deposits to the Federal Deposit Insurance Corporation, which goes into a fund that pays depositors the value of their bank deposits up to $250,000 if the bank should go bankrupt. Workmen's compensation insurance. Employers are required by law to pay a small percentage of their salaries that they pay into funds, typically run at the state level, that pay benefits to workers who suffer an injury on the job. And last, retirement insurance. All workers pay a percentage of their income into Social Security and into Medicare. They function like insurance in the sense that individuals make regular payments into the program today in exchange for benefits they will receive in the case of a later event, either becoming old or becoming sick when old. A name for such program is social insurance. Not all of those who purchase insurance face the same risks. Some people may be more likely, because of genetics or personal habits, to fall sick with certain disease. Some people may live in an area where car theft or home robbery is more likely than in other areas. Some drivers are safer than others. We can define a risk group as a group that shares roughly the same risk of an adverse event occurring. Insurance companies often classify people into risk groups and charge lower premiums to those with lower risks. If people are not separated into risk groups, then those with low risk must pay for those with high risks. If it's possible to classify drivers according to risk groups, then the insurance company can charge each group according to its expected losses. Classifying people into risk groups can be controversial. For example, if someone had a major automobile accident last year, should the insurance company classify that person as a high-risk driver who is likely to have more similar accidents in the future, or as a low-risk driver who was just extremely unlucky? The driver is likely to claim to be low risk, and thus someone should be in a risk group with those who pay low insurance premiums in the future. The insurance company is likely to believe that, on average, having a major accident is a signal of being a high-risk driver, and thus try to charge this driver higher insurance premiums. Let's take a look at the two major problems of imperfect information in insurance market: moral hazard and adverse selection. Both problems arise from attempts to categorize those purchasing insurance into risk groups. Moral hazard refers to the case when people engage in riskier behavior with insurance than they would if they did not have insurance. For example, if you have health insurance that covers the cost of visiting the doctor, you may be less likely to take precautions against catching an illness that might require a doctor's visit. In another example, a business without insurance might install absolute top-level security and fire sprinkler systems to guard against theft and fire. If it is insured, that same business might only install a minimum level of security and fire sprinkler systems. We cannot eliminate moral hazard, but insurance companies have some ways of reducing its effect. Investigations to prevent insurance fraud are one way of reducing the extreme cases of moral hazard. Insurance companies can also monitor certain kinds of behavior. To return to the example from above, they might offer a business a lower rate on property insurance if the business installs a top-level security and fire sprinkler system and has those systems inspected once a year. Another method to reduce moral hazard is to require the injured party to pay a share of the cost. For example, insurance companies often have deductibles, which is an amount that the insurance policyholder must pay out of his or her own pocket before the insurance coverage starts paying. Health insurance policies often pay a co-payment in which the policyholder must pay a small amount. For example, a person might have to pay $20 for each doctor visit, and the insurance company would cover the rest. Another method of cost sharing is co-insurance, which means that the insurance company covers a certain percentage of the cost. For instance, insurance company might pay for 80% of the cost of repairing a home after a fire, but the homeowner would pay the other 20%. All of these forms of cost sharing discourage moral hazard because people know that they will have to pay something out of their own pocket when they make an insurance claim. A final way of reducing moral hazard, which is especially applicable to healthcare, is to focus on healthcare provider incentives of providers rather than consumers. Traditionally, most healthcare in the United States has been provided on a fee-for-service basis, which means that medical care providers are paid for the services they provide and are paid more if they provide additional services. However, in the last decade or so, the structure of healthcare provision has shifted to an emphasis on health maintenance organizations, or HMOs. A health maintenance organization, HMO, provides healthcare that receives a fixed amount per person enrolled in the plan, regardless of how many services are provided. In this case, a patient with insurance has an incentive to demand more care, but the healthcare provider, which is receiving only a fixed payment, has an incentive to reduce the moral hazard problem by limiting the quantity of care provided, as long as it will not lead to worse health problems and higher costs later. Imperfect information is the cause of the moral hazard problem. If an insurance company have perfect information on risk, it could simply raise its premium every time an insured party engages in riskier behavior. However, an insurance company cannot monitor all the risks that people take all the time, and so even with various checks and cost sharing, moral hazard will remain a problem. Besides that, we also have the problem of adverse selection. Adverse selection refers to the problem in which insurance buyers have more information about whether they are high risk or low risk than the insurance company does. This creates an asymmetric information problem for the insurance company because buyers who are high risk tend to buy more insurance without letting the insurance company know about their higher risk. For example, someone purchasing health insurance or life insurance probably knows more about their family's health history than an insurer can reasonably find out, even with a costly investigation. Someone purchasing car insurance might know that he or she are a high-risk driver who has not yet had a major accident, but it is hard for the insurance company to collect information about how people actually drive. As a result, the insurance company loses money on the high-risk group, but raising premiums will discourage those with low risk from buying insurance. So the insurance company may decide not to sell insurance at all in a given market. If an insurance market is to exist, then one of two things must happen. First, the insurance company might find some way of separating insurance buyers into risk groups with some degree of accuracy and charging them accordingly, which in practice often means that the insurance company tries not to sell insurance to those who may pose high risk. Another scenario is that those with low risk must buy insurance even if they have to pay more than the actually fair amount for their risk group. The notion that people can be required to purchase insurance raises the issue of government laws and regulations that influence the insurance industry. The U.S. insurance industry is primarily regulated at the state level. The state insurance regulators typically attempt to accomplish two things: to keep the price of insurance low and to ensure that everyone has insurance. If insurance premiums are set at actually fair levels so that people end up paying an amount that accurately reflects their risk group, certain people will end up paying considerable amounts. For example, young male drivers have more car accidents than young female drivers. Thus, actually fair insurance would tend to charge young men much more for car insurance than young women, because people in high-risk groups would find themselves charged so heavily for insurance, they might choose not to buy insurance at all. State insurance regulators have sometimes reacted by passing rules that attempt to sell low premiums for insurance. Over time, however, the fundamental law of insurance must hold. The average amount individuals receive cannot exceed the average amount paid in premiums. When rules are passed to keep premiums low, insurance companies try to avoid insuring any high-risk or even medium-risk parties. If a state legislature passes strict rules requiring insurance companies to sell to everyone at low prices, the insurance companies always have the option of withdrawing from doing business in that state. In short, government regulators cannot force companies to charge lower prices and provide high levels of insurance coverage, and thus take losses for a sustained period of time. If insurance premiums are set below the actually fair level for a certain group, some other group will have to make up the difference. There are two other groups who can make up the differences. They are taxpayers or other insurance buyers. In some industries, the US government has decided free markets will not provide insurance at an affordable price, so the government pays for it directly. For example, private health insurance is too expensive for many people whose incomes are too low. To combat this, the US government, together with the states, runs the Medicaid program, which provides health care to those with low incomes. Private health insurance also does not work well for the elderly because their average healthcare costs can be very high. Therefore, the US government started the Medicare program, which provides health insurance to all those over the age of 65. Another common government intervention in insurance markets is to require that everyone buy certain kinds of insurance. For example, most states legally require car owners to buy auto insurance. Likewise, when a bank loans someone money to buy a home, the person is typically required to have homeowners insurance, which protects against fire and other physical damages like hailstorms to the home. A legal requirement that everyone must buy insurance means that insurance companies do not need to worry that those with low risk will avoid buying insurance. Since insurance companies do not need to fear adverse selection, they can set their prices based on an average for the market, and those with lower risk will, to some extent, end up subsidizing those with higher risk. This is it for asymmetric information, imperfect information, and insurance markets. Let's move on to another exciting topic, which is financial markets. In financial markets, we will focus on how businesses raise financial capital and how households supply financial capital. Many firms, from huge companies like GM to startup firms writing computer software, do not have the financial resources within the firm to make all the desired investments. These firms need financial capital from outside investors, and they are willing to pay interest for the opportunity to obtain a rate of return on the investment for that financial capital. On the other side of the financial market, financial capital suppliers, like households, wish to use their savings in a way that will provide a return. Individuals cannot, however, take a few $1,000s that they save in any given year, write a letter to General Motors or GM or some other firm, and negotiate to invest their money with that firm. Financial capital markets bridge this gap. That is, they find ways to make the inflows of funds from many separate financial capital suppliers and transform it into the funds of financial capital demanders desire. Such financial markets include stocks, bonds, bank loans, and other financial investments. Let's take a look at the demand or borrower side first. Firms often make decisions that involve spending money in the present and expecting to earn profits in the future. Firms can raise the financial capital they need to pay for such projects in different ways. For many small businesses, the original source of money is the business owner. Besides that, firms can borrow money from early-stage investors. We call them venture capitals. They are firms that make financial investments in new companies that are still relatively small in size but have potential to grow substantially. They do more than just supply money to small startups. They also provide advice on potential products, customers, and key employees. For many established companies, reinvesting their own profits is one primary source of financial capital. When a firm has a record of at least earning significant revenues and better still on earning profits, the firm can make a credible promise to pay interest, and so it becomes possible for the firm to borrow money. Firms have two main borrowing methods: banks and bonds. A bank loan for a firm works in much the same way as a loan for an individual who is buying a car or a house. The firm borrows an amount of money and then promises to repay it, including some rate of interest, over a predetermined period of time. If the firm fails to make its loan payments, the bank or banks can often take the firm to court and require it to sell its buildings or equipment to make the loan payments. Another source of financial capital is a bond. A bond is a financial contract. A borrower agrees to repay the amount that it borrowed and also an interest rate over a period of time in the future. A corporate bond is issued by firms, but bonds are also issued by various levels of government. For instance, a municipal bond is issued by cities, and a treasury bond is by the federal government through the U.S. Department of the Treasury. A bond specifies an amount that one will borrow, the interest rate that one will pay, and the time until repayment. Anyone who owns a bond and receives the interest payments is called a bondholder. If a firm issues bonds and fails to make the promised interest payments, the bondholders can take the firm to court and require it to pay, even if the firm needs to raise the money by selling buildings or equipment. However, there's no guarantee the firm will have sufficient assets to pay off the bonds. The bondholders may recoup only a portion of what it loaned the firm. Bondholders are different with shareholders. Shareholders are the ones who own some shares of stock in a firm. Stock represents firm's ownership. Firm may raise funds to finance their operations or new investments through issuing bonds or selling stock. We call a firm's first stock sale to the public an initial public offering or IPO. The IPO is important for two reasons. For one, the IPO and any stock issue thereafter, such as stock held as treasury stock, shares that a company keeps in their own treasury, or new stock issued later as a secondary offering, provides the fund to repay the early-stage investors like the angel investors and the venture capital firms. A venture capital firm may have a 40% ownership in this firm. When the firm sells stock, the venture capital firm sells its part ownership of the firm to the public. A second reason for the importance of the IPO is that it provides the established company with financial capital for substantially expanding its operations. When a firm decides to issue stock, it must recognize that investors will expect to receive a rate of return. That rate of return can come in two forms. A firm can make a direct payment to its shareholders, called a dividend. Alternatively, a financial investor might buy a share of stock in Walmart for $45 and then later sell it to someone else for $60. That is $15 gain. We call the increase in the stock value between when one buys and sells it a capital gain. So who makes the decisions about when a firm will issue stock or pay dividends or reinvest profits? To understand the answers to these questions, it is useful to separate firms into two groups, private and public. A private company is owned by the people who run it on a day-to-day basis. Individuals can run a private company. If a group runs it, we call it a partnership. A private company can also be a corporation, but with no publicly issued stock. Most private companies are relatively small, but there are some large private corporations with tens of billions of dollars in annual sales that do not have publicly issued stock. When a firm decides to sell stock, which financial investors can buy and sell, we call it a public company. Shareholders own a public company. Since the shareholders are a very broad group, often consisting of thousands or even millions of investors, the shareholders vote for a board of directors who in turn hire top executives to run the firm on a day-to-day basis. So how firms choose between financial capital sources? There are clear patterns in how businesses raise financial capital. We can explain these patterns in terms of imperfect information. Recall that imperfect information is a situation where buyers or sellers or both do not have full and equal information. Those who are actually running a firm will almost always have more information about whether the firm is likely to earn profits in the future than outside investors who provide financial capital. Any young startup firm is a risk. Some startup firms are only a little more than an idea on paper. The firm's founders inevitably have better information about how hard they are willing to work and whether the firm is likely to succeed than anyone else. When the founders invested their own money into the firm, they demonstrate a belief in its prospects. At this early stage, angel investors and venture capitalists try to overcome the imperfect information, at least in part, by knowing the managers and their business plan personally and by giving them advice. They could co-found corporate governance, the institutions that are supposed to watch over top executives of a company. As a firm becomes at least somewhat established and its strategy appears likely to lead to profits in the near future, knowing the individual managers and their business plans on a personal basis becomes less important because information has become more widely available regarding the company's products, revenues, costs, and profits. As a result, other outsider investors who do not know the managers personally, like bondholders and shareholders, are more willing to provide financial capital to the firm. At this point, a firm must often choose how to access financial capital. It may choose to borrow from a bank, issue bonds, or issue stock. The great disadvantage of borrowing money from a bank or issuing bonds is that the firm commits to scheduled interest payments, whether or not it has sufficient income. The great advantage of borrowing money is that firm maintains control of its operation and is not subject to shareholders. Issuing stock involves selling off company ownership to the public and become responsible to a board of directors and the shareholders. The benefit of issuing stock is that a small and growing firm increases its visibility in the financial markets and can access large amounts of financial capital for expansion without worrying about repaying this money. If the firm is successful and profitable, the board of directors will need to decide upon a dividend payout or how to reinvest profits to further grow the company. The ways in which firms would prefer to raise funds are only half of the story of financial markets. The other half is what those households and individuals who supply funds desire and how they perceive the available choices. We can divide the mechanisms for savings available to households into several categories: deposits in bank accounts, bonds, stocks, money market mutual funds, stock and bond mutual funds, and housing and other tangible assets like owning gold. We need to analyze each of these investments in terms of three factors: the expected rate of return it will pay, the risk that the return will be much lower or higher than expected, and the investment's liquidity, which refers to how easily one can exchange money or financial assets for a good or service. First, we need to understand the difference between expected rate of return and actual rate of return. The expected rate of return refers to how much a project or an investment is expected to return to the investor, either in future interest payments, capital gains, or increased profitability. It is usually the average return over a period of time, usually in years or even decades. Risk measures the uncertainty of that project's profitability. There are several types of risk, including default risk and interest rate risk. Default risk, as its name suggests, is the risk that the borrower fails to pay back the bond or loan. Interest rate risk is the danger that you might buy a long-term bond at a 6% interest rate right before the market rates suddenly rise. You could have received a similar bond that paid 9%. A high-risk investment is one for which a wide range of potentially payoffs is reasonably probable. A low-risk investment may have actual returns that are fairly close to its expected rate of return year after year. A high-risk investment will have actual returns that are much higher than the expected rate of return in some months or years and much lower in other months or years. The actual rate of return refers to the total rate of return, including capital gains and interest paid on an investment at the end of a time period. Now, let's take a look at the relationship between savers, banks, and borrowers. In financial capital markets, banks are an example of a financial intermediary, that is, an institution that operates between a saver who deposits funds in a bank and a borrower who receives a loan from that bank. Banks offer a range of accounts to serve different needs. A checking account typically pays little or no interest, but it facilitates transactions by giving you easy access to your money, either by writing a check or by using a debit card. A saving account typically pays some interest rate, but getting the money typically requires you to make a trip to the bank, or you can access the funds electronically. Another way to deposit savings at a bank is to use a certificate of deposit or CD. With a CD, you agree to deposit a certain amount of money in the account for a stated period of time, typically ranging from a few months to several years. In exchange, the bank agrees to pay a higher interest rate than for a regular savings account. The great advantages of bank accounts are that financial investors have very easy access to their money, and also money in bank accounts is extremely safe. In part, this safety arises because the bank account offers more security than keeping a few $1,000s at home. In addition, the Federal Deposit Insurance Corporation protects the savings of the average person. Every bank is required by law to pay a fee to the FDIC based on the size of its deposits. Then, if a bank should go bankrupt and not be able to repay depositors, the FDIC guarantees that all customers will receive their deposits back up to $250,000. The bottom line on bank accounts look like this. Low risk means low rate of return, but high liquidity. Another way for people to save is to buy bonds. A bond is basically an IOU note that an investor receives in exchange for capital or money. An investor who buys a bond expects to receive a rate of return. However, bonds vary in the rates of return that they offer according to the riskiness of the borrower. The US government is an extremely safe borrower, so when the US government issues Treasury bonds, it can pay a relatively low interest rate. Firms that appear to be safe borrowers perhaps because of their sheer size or because they have consistently earned profits over time, will still pay a higher interest rate than the US government. Firms that appear to be riskier borrowers, perhaps because they are still growing or their businesses appear shaky, will pay the highest interest rate when they issue bonds. We call bonds that offer high interest rate to compensate for their relatively high chance of default, high-yield bonds or junk bonds. In financial terms, a bond has several parts. The bond has a face value. This is the amount that the borrower agrees to pay the investor at maturity. The bond has a coupon rate or interest rate, which is usually semi-annual, but can be paid at different times throughout the year. The bond has the maturity date when the borrower will pay back its face value as well as its last interest payment. Combining the bond's face value, interest rate, and maturity date and market interest rates allows a buyer to compute a bond's present value, which is the most that a buyer would be willing to pay for a given bond. This may or may not be the same as the face value. The bond yield measures the rate of return a bond is expected to pay over time. Investors can buy bonds when they are issued, and they can buy bonds and sell them during their lifetimes. When buying a bond that has been around for a few years, investors should know that the interest rate printed on a bond is often not the same as the bond yield. Let's take a look at a numerical example of bond yield. Assume that you have bought a $1,000 bond whose coupon rate or interest rate is 8%, so your annual payment is $80 per year until its maturity. Now, assume that over time the interest rates prevailing in the economy rise to 12% and that there is now only 1 year left to your bond's maturity. This makes the bond an unattractive investment since an investor can find another bond that perhaps pays 12%. To induce the investor to buy the 8% bond, the bond seller will lower its price below its face value of $1,000. The expected payment from the bond 1 year from now are $1,080 because in the bond's last year, the bond's issuer will make the final interest payment and then also repay the original $1,000. Given that interest rates are now 12%, you know that you could invest $964 in an alternative investment and receive $1,080 a year from now. That is $964 times 1 plus 0.12 or 12%. That gives you $1,080. Therefore, you will not pay more than $964 for the original $1,000 bond. So $964 is the present value of this bond. Consider that the investor will receive the $1,000 face value plus $80 for the last year's interest payment. The yield on the bond will be $1,080 minus $964 divided by 964, you get 12%. Note that the interest or coupon rate of the bond, which was 8%, did not change. When interest rates rise, bonds previously issued at a lower interest rate will sell for less than face value. Conversely, when interest rates fall, bonds previously issued at higher interest rates will sell for more than face value. Besides bonds, people can also buy stocks. The rate of return on a financial investment in a share of stock can come in two forms: as dividends paid by the firm and as a capital gain achieved by selling the stock for more than you paid. The rate of return over time for stocks won't be high, but the risks are also high, especially in the short run. Liquidity is also high since one can sell stock in publicly held companies readily for spendable money. Buying stocks or bonds issued by a single company is always somewhat risky though. Thus, a standard recommendation from financial investors is diversification, which means buying stocks or bonds from a wide range of companies. Purchasing a diversified group of stocks or bonds has become easier in the internet age. Companies offer mutual funds, which consist of a variety of stocks or bonds from different companies. The financial investor buys mutual fund shares and then receives a return based on how the fund as a whole performs. We call a mutual fund that seeks only to mimic the market's overall performance an index fund. The rate of return over time for mutual funds will be high. The risks are also high, but the risks and returns for an individual mutual fund will be lower than those for an individual stock. As with stocks, liquidity is also high provided the mutual fund or stock index fund is readily traded. Households can also seek a rate of return by purchasing tangible assets, especially housing. About 2/3 of US households own their own home. An owner's equity in a house is the monetary value the owner would have after selling the house and repaying any outstanding bank loans he or she used to buy the house. Investment in a house is tangibly different from bank accounts, stocks, and bonds because a house offers both a financial and a non-financial return. If you buy a house to live in, part of the return on your investment occurs from your consumption of housing services, that is, having a place to live. Buying a house to live in also offers the possibility of a capital gain from selling the house in the future for more than you paid for it. Investors can also put money into other tangible assets such as gold, silver, and other precious metals, or in dollar commodities like sugar, coffee, oranges, or natural gas. Typically, investors in these commodities never even see the physical good. Instead, they sign a contract that takes ownership of a certain quantity of these commodities, which are stored in a warehouse, and later they sell the ownership to someone else. The return on these investments derives from the saver's hope of buying low, selling high, and receiving a capital gain. A final area of tangible assets consists of collectibles like paintings, fine wine, jewelry, antiques, or even baseball cards. Most collectibles provide returns both in the form of services or a potentially higher selling price in the future. You can use paintings by hanging them on the wall, jewelry by wearing them. You can also hope to sell them someday for more than you paid for them. The bottom line on investing in tangible assets is that rate of return moderate, especially if you can receive non-financial benefits from, for example, living in the house. Risk, moderate for housing or high if you buy gold or baseball cards. Liquidity, low, because it often takes considerable time and energy to sell a house or a piece of fine art and turn your capital gain into cash. That's it for now. Thanks for watching such a long video. Keep calm and study on.